Hello everyone, so we are from group 13 and our topic is all about capital market theory. So part of the capital market theory is Markowitz portfolio theory, capital market theory and assumptions, capital asset pricing model or KEPM, and mean variance analysis. All adage is don't put your eggs in one basket, but how many baskets should you use and what proportion of your eggs should you put in one basket? So Harry Markowitz resolved with these questions. He figured out a way to answer both of them. Markowitz also earned a Nobel Prize in Economics in 1990 for his efforts. So Markowitz portfolio theory also quantifies risk, derives expected rate of return for a portfolio of assets and expected risk measures. He also shows the variance of the rate of returns is meaningful measure of portfolio risk. He also derives the formula computing the variance of a portfolio, showing how to effectively diversify a portfolio. He also provides both the foundation for modern finance, a key tool for Haugen's new finance. So there are 5 assumptions of Markowitz portfolio theory. First is investor view potential investments in terms of the distributions of their returns over some given holding period. Number 2. Investors maximize one period expected utility and their utility curves demonstrate diminishing marginal utility wealth. So, meaning investors like higher returns but they are risk averse in seeking those returns. So, and again, this is one period model that the portfolio will need to be rebalanced at some point in the future in order to remain optimal. Number 3. Investors measures the rest of their portfolios in terms of the variance of portfolios return. So, meaning, variance daw is the key of measuring the rest. Number 4. Investors base decisions solely on expected return and rest due to either investor utility curves are functions of only expected return and the variance or standard deviation of shares. Stocks returns are normally distributed or follow some other distribution that is fully described by mean and variance. Lastly, for the given risk level, investors prefer higher returns to lower returns. So, similarly, for a given level of unexpected returns, investors prefer less risk to more risk. So, using these 5 assumptions, a single asset or portfolio of assets is considered to be efficient if no other asset or portfolio of assets offers higher expected return, so with the same or lower risk, or lower risk with the same or higher of expected return. So that's all for the Markowitz portfolio theory. Thank you for listening. So next to report is Miss Noji Saburao.
Hello everyone, my name is Noji Saburao. So I will be reporting the capital market theory assumptions. Capital market theory extends Markowitz model to a situation when a risk-free asset is introduced in the capital market. It also assumes that investors are rational and mean variance optimizers, and as assumed by Markowitz portfolio theory. It based on the following assumptions. 1. Investors make decisions solely on the basis of risk-return assessments. 2. Securities are infinitely divisible, which means that investors can hold any amount of the asset. This assumption was created because predictions of the model would be inaccurate as the indivisible assets would require a great amount of initial wealth of fund investors. 3. There are no restrictions on short selling. Short selling remains legal around much of the world today, and temporary bans on shorting due to market turmoil have been rescinded once those crises. 4. There are many investors and the buy or sell transactions of any investors will not affect the price of securities. 5. There are no transaction costs of taxes. 6. There is a risk-free asset in the market beside risky assets. 7. Investors have identical or homogeneous expectation about the returns, variance of returns, and covariance of all pairs of securities. This assumption is important so as to have unique, efficient frontier. Capital market line. The capital market line is given in the following equation. So, expected return of the portfolio equals the risk-free rate of interest and the expected return on the market portfolio minus the risk-free rate of interest, then the standard deviation of the portfolio over the standard deviation of the market portfolio. So the capital market line shows that the return from a portfolio depends upon the risk-free rate reward per unit of market. Risk and total risk of the portfolio, the higher the risk, the higher will be the expected return. The next slide will be report by Lorraine Verdon.
Good day, ma'am. The topic that I'm going to report is all about Capital Asset Pricing Model, or CAPM. CAPM, or Capital Asset Pricing Model, is a model that describes the relationship between risk and expected return and that is used in the pricing of risky securities. The model was introduced by Jack Traynor, William Sharpe, John Lentner, and John Mosen, independently building on the earlier work of Harry Markowitz on diversification and modern portfolio theory. The general idea behind CAPM, or Capital Asset Pricing Model, is that investors need to be compensated in two ways: time value of money and risk. Next is assumptions. Assumption can lend and borrow unlimited amounts under the risk-free rate of interest. Individuals seek to maximize the expected utility of their portfolios over a single period planning horizon. Assume all information is all available at the same time to all investors. The market is perfect. There are no taxes. There are no transaction costs. Securities are completely divisible. The market is competitive. The quantity of risky securities in the market is given. Next is implication and relevance of capital asset pricing model. Investors will always combine a risk-free asset with a market portfolio of risky assets. Investors will invest in risky assets in proportion to their market value. Investors can expect returns from their investment according to the risk. This implies a linear relationship between the asset's expected return and its beta. Investors will be compensated only for that risk which they cannot diversify. This is the market-related systematic or risk. Next is CAPM equation, or the capital asset pricing model equation. As you can see here from the top of the screen is the equation of the capital asset pricing model. Next is beta. Beta is a measure of the volatility or systematic risk of a security or a portfolio in comparison to the market as a whole. Beta is used in the capital asset pricing model, a model that calculates the expected return of an asset based on its beta and expected market returns, also known as beta coefficient. Next is limitations. Capital asset pricing model has the following limitations. First is it is based on realistic assumptions. Second, it is difficult to test the validity of capital asset pricing model, or CAPM. Lastly, betas do not remain stable over time. Last is conclusion. Research has shown the CAPM, or capital asset pricing model, to stand up well to criticism. Although attacks against It has been increasing in recent years until something better presents itself. However, the capital asset pricing model remains a very useful item.
What is mean variance analysis? Mean variance analysis is the process of bringing risk expressed as variance against expected return. The analysis helps investors determine the biggest reward at a given level of risk or the least risk at a given level of return. So, the variance shows how spread out the returns of a specific security are on a daily or weekly basis. The expected return is a probability expressing the estimated return of the investment in the security. If two different securities have the same expected return, but one has lower variance, so the one with the lower variance is preferred. So similarly, if two different securities have approximately the same variance, so the one with the higher return is preferred. Understanding mean variance analysis. So mean variance analysis is one part of the modern portfolio theory, which assumes that investors will make rational decisions about investment if they have complete information. One assumption is that investors seek low risk and high reward. So there are two main components of mean variance analysis. First is variance. Variance is a number that represents how varied or spread out the numbers are set. For example, variance may tell how spread out the returns of a specific security are on a daily or weekly basis. So the expected return is a probability expressing the estimated return of investment in the security. If two different securities have the same expected return, but one has lower variance, the one with the lower variance is the better pick. So similarly, if two different securities have approximately the same variance, so the one with the higher return is the better to pick. In the modern portfolio theory, an investor would choose different securities to invest in the different levels of variance and expected return. The goal of this strategy is to differentiate investments, which reduces the risk of catastrophic loss in the event of rapidly changing market conditions. So, for example, of mean variance analysis. Assuming the following investments are in investors' portfolio. So, for example, investment A, amount of equals to $100,000 and expected return of 5%, while investment B, amount equals $300,000 and expected return of 10%. So in the portfolio value of $400,000, the weight of each asset, so $300,000 plus $100,000 equals to $400,000. So investment A weight equals to $100,000 divided $400,000 equals to 75%. So investment B weight is $300,000 divided $400,000 equals to 75%. Therefore, the total expected return of the portfolio is the weight of the asset in the portfolio multiplied by the expected return.
That would be all. Thank you.